Supermicro posted record-breaking quarterly revenue, more than doubling its sales in a surge driven by AI demand. Yet, in a surprising turn, the stock's initial celebration was short-lived, with a sharp price drop just a day later. This week, we look at the numbers behind the volatility. With sales booming but profit margins getting squeezed, is the market signaling a breakout or a warning? Welcome to TickerWatch News for Supermicro, Week 6, 2026. This is this week's summary of the news and developments for Supermicro, a key player in the AI infrastructure space. It was a volatile week for Supermicro. The company's shares grew by about 18% week-on-week, but the path wasn't smooth. Following a strong earnings report on February 4th, the stock surged over 13%, only to reverse course and fall more than 8% the next day. It ended the week trading in the range of $31 to $33 per share. This price action came amid heavy trading volume, particularly around the earnings announcement, as the broader technology sector saw a rebound. The biggest story of the week was Supermicro's stellar fiscal second quarter earnings report. The company announced revenues of approximately $12.7 billion, a 123% jump from the same period a year earlier. This result significantly beat analyst expectations, which were closer to $10.4 billion. Management attributed the performance to strong demand for its AI server and storage technology, robust customer engagements, and an expanding global manufacturing footprint. However, the earnings report also revealed a significant challenge: shrinking profitability. Gross margins fell to 6.3% in the quarter, a noticeable decline from 9.3% in the prior quarter and 11.8% a year ago. This drop puts margins below the company's own guidance. The pressure on profitability appears to stem from a difficult position between paying high prices for key components and selling to very large, powerful customers who can negotiate favorable pricing. The company cited customer mix, tariffs, expansion costs, and component shortages as contributing factors. Adding to the margin concerns is the company's high customer concentration. Analyst reports this week highlighted that a single large data center customer accounted for over 60% of revenue in the quarter. This heavy reliance on one main buyer can lead to unpredictable quarterly results and reduces the company's leverage in price negotiations. Despite the margin pressure, Supermicro provided a very optimistic outlook for the future. The company is targeting net sales of $12.3 billion for the upcoming third quarter. More significantly, it raised its full-year revenue guidance to at least $40 billion, a substantial increase from its previous forecast of $33 billion. This suggests management is confident that the powerful demand for AI infrastructure will continue and that it can meet that demand. The market's reaction to the week's news was mixed, reflecting the dual narrative of high growth and shrinking margins. The analyst community appears cautiously optimistic, with the consensus rating on the stock moving from hold to moderate buy over the last couple of months. Still, individual analyst actions show a divided view. Citi reiterated a neutral rating with a $39 target, praising the strong demand while pointing out the risks to margins and customer concentration. In contrast, Raymond James cut its price target on the stock to $35 from $50. The overall narrative in the news is bullish on the company's role as a core supplier for the AI build-out, but remains wary of the profitability challenges. Reports also noted significant insider selling over the past 3 months, which some investors may view as a caution flag. From a technical view, the stock has been extremely volatile. After peaking near $118 in March of 2024, it has fallen significantly. This past week saw a surge on high volume following the earnings news, briefly pushing it above its 50-day moving average, but it failed to hold that level. The $35 mark is being watched by traders as a key resistance level. On the fundamental side, the picture is complex. By valuation metrics like the forward price to earnings earnings ratio, which stands in the low to mid-teens according to various reports, the stock appears inexpensive for an AI-related company. However, the fundamental view is clouded by risks. The company's debt-to-equity ratio is reported to be nearly 67%, well above the industry average. The primary concern remains the declining gross margin, which raises questions about the long-term quality of this rapid sales growth. Looking ahead, the main focus for investors will be how the market continues to digest this new environment of high growth paired with low margins. There are no major company-specific events scheduled, but market participants will be watching for any commentary on the adoption of Supermicro's new data center building block solutions, which the company hopes will carry higher margins. Key price levels to monitor include support around the $30 mark and the resistance level near $35. A sustained break above that resistance could signal a shift in momentum. The bull case rests on revenue growth continuing at its current pace, while the company diversifies its customer base and improves margins. The bear case is that profitability pressures persist, and the impressive sales growth fails to translate into meaningful profit. For now, continued volatility seems to be the most likely scenario. Thank you for tuning in to TickerWatch. This podcast is for informational and educational purposes only and does not constitute financial advice. Be sure to subscribe, leave a review, and share this episode.